The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Juliana Tattelbaum. These are your headlines. The inflation impact of Trump's tariffs fails to show in July's CPI print, leading investors to ramp up bets on a September Fed cut and pushing global equity markets higher.
European leaders prepare for today's virtual talks with Presidents Trump and Zelenskyy, calling on the U.S. leader to safeguard Ukrainian territory and not bow to Putin's demands at Friday's Alaska summit.
And software stocks on both sides of the Atlantic tumble, with SAP posting its worst day since the COVID outbreak, as investors begin to fret that AI could upend many of the world's biggest software companies. Good morning. How are we?
Very well.
Feeling sprightly in the middle of the week?
Hump day.
I want to talk about my dog, which is not what you expected.
That's a different show, isn't it?
No, that's craft. Pets are us. No, because I tell the viewers, I have a black Labrador. And he is lovely and he's wonderful, but he makes a noise when the postman comes down our drive, and he makes a real noise when my wife's Amazon deliveries turn up and my daughter's Shein deliveries, and he barks so loudly. His bark is enormous. But if the postman had the temerity to ever open our front door, oh my God, he would cower. He was the most terrified dog on the planet. He is all bark and no bite. Now you know where I'm coming from.
He's a bit of a taco. He's a taco trade.
No. He's a bit like CPI. Because at the moment, all anyone is worried about, and all our brilliant economist guests, and even from Goldman Sachs, dare I say it, whose boss is a DJ, we'll come to that in a couple of minutes as well. Even at Goldman Sachs, they think it's going to come through that in due course, the effect from tariffs will hit the consumer and will hit consumer pricing. But at the moment, the president and the administration is gleeful because, like my black Labrador, the noise about tariff impact on CPI is all bark and no bite.
Yeah, well, this was our point
Unlike your
earlier
little
in the
dog,
week.
which I reckon's all bite.
Well, she's got one little tooth at the front, so that little bite's not going to hurt anyone these days. But I think the reality around the timing of what the president has also enacted with China, don't forget we were talking at the start of the week about kicking the China negotiations further out. So the reality is that big bite that may have come through from the Chinese impact is not coming through because the negotiations are still happening. So the staggered nature of the tariffs is one thing to take into account. The other fact is that you've got all these Fed officials, predictors, now trying to work out when the first rate cut should happen. But because the data is not falling into line, it's making it very difficult for them to hold the line, saying, wait, the tariff effect, the bite's coming, hold back, wait. I think the pressure is very much coming to bear on those central bank members.
I think also we're talking as if a bite is expected, but it's actually more of a nibble. But ultimately, that dog is biting a little bit, and
yes.
it's basically a trickle effect. We're not going to see some major boom in these inflation numbers. That's not the expectation here. But over time, we'll see it nibbled away, and the full impact of these tariffs is not expected until next year.
Which brings us to the counterfactual, of course, which is what would inflation be now if we hadn't had the tariffs? And I'll pick up a slight bit on what you said about the China. You're absolutely right, of course, we don't know the full impact of China, but there are extra tariffs in place, and they are bringing extra revenues in. In fact, we've seen a tripling in July figures, I think it was. It may be the June, but I'll confirm that. We had the numbers out in July, of the actual amount of revenue taken in by US taxation authorities, or whether it's the customs authorities, from tariffs as well. So the money is coming out. The question is it the countries who are paying a part of this, as well as the Trump administration thinks, or is it the companies that are paying this as well, and negating any impact ultimately on the consumer? And the question is, with the counterfactual, are we actually seeing the effects now? And would inflation, without the tariffs in place, be significantly lower and have opened the door already for the Fed to be more aggressive on rate cuts?
Yeah, I mean, there's a lot to plug into the data. And I think the reality is the market has now switched behind the administration when expecting rate cuts to come September. Now, consumer price inflation rose 2.7% on the year in July across the United States. Less than expected, as we've been fleshing out, but still well outside the Fed's 2% target. The core print came in at 3.1% for the year, the highest level since February. Tuesday's cooler than expected headline CPI print has seen traders up their bets on a rate cut from the Fed in September. According to the CME Group's Fed Watch tool, investors are pricing in a more than 94% chance of a 25 basis point cut next month. Some have gone further, with Treasury Secretary Scott Bessent suggesting the Fed should consider a 50 basis point move. BlackRock's Chief Investment Officer of Global Fixed Income, Rick Ryder, said a 50 basis point move lower from the Fed could be justified. President Trump has called on Goldman Sachs CEO David Solomon to replace an economist or, quote, just focus on being a DJ. Trump's broadside against Solomon comes just days after the lender issued a note written by chief economist Jan Hatzius that warned consumers will end up absorbing up to 67% of costs related to the president's tariff policy. The US leader made the demand in a Truth Social post where he touted the increasing revenue streams from his tariff policy. But of course, don't forget other economists forecasting something very similar to Goldman Sachs. Now, speaking to CNBC, Council of Economic Advisors Chair and President Trump's nominee to the Federal Reserve Board of Governors, Stephen Mirren, said there has been no sign of any inflation arising from tariffs.
I can tell you that we're very happy to see that inflation continues to be well behaved. Since the president took office in February, CPI inflation has been running at a 1.9% annualized rate, which is a totally normal pattern of behavior for inflation and for prices. There's just still continues to be no evidence whatsoever of any tariff-induced inflation. I think lots of folks who are expecting that, who are predicting doom and gloom, it just hasn't panned out, and it continues to not pan out for them.
As for the market reaction, we saw equities move higher yesterday, sentiment improve on the back of that tamer than expected inflation report. And as Karen said, we have seen expectations of a September rate cut increase on the back of it. We're looking now at the Dow, the S&P 500 and the Nasdaq, all up more than 1% on the session. All 11 sectors in the S&P gained over the course of the day, led by communication services up more than 1.5%. Consumer staples lagged, but still ended about 17 basis points higher. So overall, quite a positive session stateside. That positive sentiment has filtered through to the Asian markets overnight. Here's where things stand in that region. You got Nikkei 225 up 1.2%. Strong gains in the Hong Kong market. The Hang Seng up more than 2%. You're also seeing gains for the Shanghai Composite and the Kospi over in South Korea. Now, as for European futures, let's take a look at how the market is poised to open this morning. We had some really interesting trade yesterday. We're looking at gains across the board here as well, so that positive sentiment coming through here in Europe too. Now, yesterday, the Stoxx 600 gained about 20 basis points or so. Doesn't seem that impressive. But when you look under the surface, we had some pretty big divergence across sectors. We saw a number of sectors gain more than 1% in yesterday's trade, but technology stocks really took a hit yesterday. That sector dropped 2%. Some pretty big sell-offs in software-related stocks. A story brewing there around how AI could negatively impact a number of names in the software as a services space.
Super duper. Yeah, we'll come back to that later on, have a big chat about that. Guy Miller is Chief Market Strategist and Head of Macroeconomics at Zurich Insurance. Mr. Miller, very good morning to you, sir. Look, in your notes, and as we've read elsewhere as well, you remind me and the team that actually we have the highest level of tariffs in the United States at the border since the 1930s. I mean, that is extraordinary. And so many things were going on in the 1930s. And many of our viewers will be aware of the dramatic moves and depression-like economics we saw during that period as well. Why do you think then, A, we're not seeing an inflationary impact from that, and B, the markets remain, for want of a better word, very glib about the downside risks to those enormous tariffs?
Well, maybe let's start up where you were speaking about earlier on, Steve, with the inflation prints that we've seen. I mean, these inflation, the tariff number is 18% average tariff rate now in the US versus 2.7% at the beginning of the year. It clearly is having an effect, or will have an effect. You also mentioned about the revenues coming in to the country, 30 billion plus a month over the last few months. And that is significant. But remember, this is not the Chinese, the Indians, or the Europeans paying these tariff levies. These are US companies, importers, companies themselves, and ultimately consumers will be picking up part of that. So I do think there will be a pass-through, maybe a little bit delayed. Maybe the companies are taking it a bit of margin right now. But one way or the other, I think this is going to show up in a bit of a higher inflation print going forward and squeeze margins. So maybe I'm sounding a bit like your black Labrador here, Steve, but I think some pain is still yet to be felt.
Yeah, but even you, and you know what? You could do worse than sound like him. He's a lovely fellow, my dog. But the fact of the matter is, these tariffs are enormous, as you quite say. 18% versus a couple of percent being paid for by American importers, whether it's the consumer, whether it's the company as well. How can that not have an effect on inflation that is more than showing up a bit in headline and a bit in core, as indeed you seem to be saying?
Well, of course, there's been some pre-buying of goods coming in. So we had quite a large stock of inventories that has before tariffs. So that needs to be worked off. As I mentioned, I think companies are taking some of it in the margin. They were waiting to see just how sticky these tariffs were going to be. So that lessens the impact on the consumer. But let's not forget, we're talking about the inflation rate yesterday. Core CPI inflation in the US is running at 3.1%. It's not 2%, it's 3.1% and expected to rise. So I think at the margin, there's things that you can say there are offsets, but ultimately the US economy will be paying for this one way or the other. So much as I hate to say it, I am siding with other economists to say that the pain is still yet to be felt.
Guy, let me ask you about the interest rate story from here, though. Scott Bessent doesn't want the job at the helm of the Fed, but weighing into where policy should go, 50 basis points, his suggestion. Is there any chance that we'll see a jumbo rate cut anytime soon?
Yeah, I'm not sure anybody wants that job at the Fed. I don't think so, Karen. I think 25 is likely to be the given number. The Fed doesn't want to imply there's any kind of panic in place. And I mentioned when you've got inflation running at 3%, when you've got unemployment still at 4.2%, close to 50-year lows, I don't think there's any need yet to signal to the market that you're having to do an outsized move. I think they'll keep it data dependent. They'll say this is the next move, 25 basis points, we'll do more ahead. But I think it would send a wrong signal were they to do 50.
Send a wrong signal to do nothing. I mean, what are the obstacles to cutting come September?
Well, I think, we've still got a number of data releases before that September meeting. We've got retail sales on Friday. We've got, of course, another inflation print, and we've got the jobs data coming out. So I think all of that will be factored in, of course, to their numbers. But I think it's pretty much baked in the price. I would agree with market pricing. We thought since the spring, 25 would happen in the September meeting, and I think that will continue to be the case in the weeks ahead. 25 likely, followed by further cuts in the months ahead.
Guy, the BLS produces both the monthly jobs report and the consumer price index inflation report. And obviously, President Trump has heavily criticized the monthly jobs report. He's fired the commissioner on the back of it. But he's touted the inflation report as evidence that the tariffs are not having an impact on inflation. Do you think that market participants have begun doubting the integrity of the data coming out of the BLS, or is this just seen as a major political story at this point?
I think you're implying that there's some inconsistency in policy and views. Well, we are living in this land of confusion, and I think the markets have had to adjust to that. Yes, data is always under question. We've spoken many times in this show that the payroll number is always a weak number, subject to massive revision. That's been the case once again. No great surprise there, but I guess it's the timing of this, given how crucial the Fed meetings are going to be. But one of the things I would point out is that we don't focus really much on the payroll numbers, but we've continued to see weakness in other measures. Of course, things like continuing claims data, the broader survey of unemployment coming from the household survey picked up to 7.9%, even though the actual unemployment rate itself is only 4.2%. So I think one always has to take the data with caution. I think when you look at the fundamentals, given what I said earlier, we're in an environment where we're likely to see growth continuing to slow and inflation gradually picking up. And so far the markets have been looking at that and saying, okay, it's not too worrying. As long as we don't get a recession, as long as we don't get a profit recession, this can allow credit markets to hold in, spreads are very tight, and the equity market can continue to move higher. I don't get a feeling that we have a lot of euphoria in the markets right now. You have reluctant buying into this. Every investor, professional investor, is waiting for the next data point. And so far it's fair to say the data has surprised fairly positively.
I think you're absolutely right. Certainly when you listen to a lot of the guests on this program, the institutional investment community, it has been a reluctant rally. And there is still so much concern about the future given the expected trickle impact that these tariffs are likely to have or expected to have on inflation. But what could be the catalyst to change the market narrative and actually drive markets lower from here?
Well, I think investors have also been assuming that actually a lot of the policies are going to be watered down. And they're focusing simply, as I said, on is there a recession or not a recession. You know, we've seen the start-stop views on copper prices. We saw the fiasco last week in terms of gold prices. So I think investors are continuing to say, look, as long as there's not a recession, as long as companies continue to post good numbers, we'll have to stick with the plan. And I guess what we've seen in the last couple of weeks in terms of earnings season, once again, it's been these large cap US tech companies that have continued to deliver supersized profits. Yes, they're expensive, but they're expensive for a reason. And again, in a time of confusion, investors are gravitating back to that consistency and that predictability. And again, that's helped the US equity market.
I want to get your thoughts on something else. I don't even know if there's a union of head of macroeconomics out there, but I'm sure you all know each other. A few years ago, it was 6 years ago now, one of the top economists at UBS got himself in trouble with China for some regrettable comments as well. And there were calls to get rid of that man at the time. And luckily, he kept his job and he's a great economist. Now, Jan Hatzius is in the firing line at Goldman Sachs from the president as well, who has basically said replace him to David Solomon as well. How do you feel about political leaders getting involved in conversations about replacing chief strategists or chief head of economics that they don't like the view of?
Steve, as we know, in many parts of the world for forever, you've seen that when data doesn't suit some of the political establishment, of course, they want to change things. This is why it's so important that we have robust institutions, a robust institutional framework, and we focus on the quality of data. I would fully agree we need to improve the quality of reported data coming out of the US and other countries, but it's vitally important that we allow the data to be reflected, to be analysed by professionals, and the market to price that appropriately. I think it is always dangerous when you start manipulating or interfering with independent frameworks, and that's something that we must absolutely guard against.
Do you worry then, given what you just said about the robust framework and robust analysis of data, that we have a more sympathetic to the president head of the BLS now in the States?
I worry generally, Steve, that we have an erosion of that independence. You know, there's many examples we've seen in recent months because I think that undermines the robustness of US global capital markets, and it will ultimately undermine the desire for companies to be investing, for investors to be investing over the long term. In the short term, it can be seen as noise, but under the long term, you know, it can be a real problem. And that's something I think is a concern. I am genuinely concerned about that. One of the great things about the US, and I've always cited it, is it's the freedom, the depth, the liquidity in these markets, the ability to analyze the data freely and consistently and allow market prices to truly price underlying fundamentals of both companies, but also the US economy as well. And that must be, as I said, safeguarded.
Guy, the FT is also running an interesting think piece today about the markets bending to the will of Trump, saying, look, there had been showing some or demonstrating some teeth early on, the Liberation Day reaction first up, reaction to the Trump tariff policy. But now if you look at the reaction on markets and how becalmed we seem to be at these levels, even with extraordinary risk, that perhaps investors too are now bending to the knee of Trump. What do you think, and what sort of risk does that pose?
Yeah, I think it's a very good point, Karen. And it's something that I've mentioned. I think I mentioned last time on the show. I was always of the belief that it was going to be ultimately market forces that would constrain some of the US administration's ambitions. It wasn't really going to be Congress or anything else. And to a large extent, we saw an example of that in April, of course, with the move in the bond market and then the backing off about the concept of removing the Fed chair. So I am a little concerned that we've had this low volatility in equity markets. We see credit spreads, as I mentioned earlier, getting back towards record lows. The market seems to be ignoring the noise and saying, look, we don't know exactly what's going to happen. We see tariffs on one day, off the next day. We're going to continue to play strong momentum, large amounts of liquidity that's still coming into the market. And that's allowing us to continue to believe that there's further upside ahead. This is a momentum driven, not really a fundamentally driven market. But you're right, as a result of that, that removes one of the constraining factors the administration will be looking at, and you've said it yourself, I think Scott Bessent mentioned it. You know, the inflation numbers are okay, the bond market isn't selling off, equity markets are holding in. This almost gives some kind of credibility to the policies. It appears that investors are embracing that. I suspect that's not going to be the case once we start to see some of the hard data, as I say, coming through. Once we start to see margins becoming under pressure, I think that's the concern. But the hope for investors, of course, is having had the pain point in April, having suffered the pain of potential tariff impact, we're now looking at the benefits coming through from the big, beautiful bill. And one of the things that was obvious in terms of corporate reporting in the last few weeks is a number of companies have mentioned about the tax advantages in terms of accelerated depreciation, in terms of business investment and capital spending. And that's something that I guess is keeping investors still in the game, still believing that we could have another quarter or two of still decent corporate earnings.
Guy, thank you so much for joining us this morning. Always great to get your views. Guy Miller, Chief Market Strategist and Head of Macroeconomics at Zurich Insurance. Coming up on the show, Perplexity launches a shock bid to buy Google's Chrome browser at a price almost double the AI startup's current valuation. Plus, software companies sell off amid concerns around what AI technology could mean for the sector. And we'll get a check on Europe's embattled renewable energy sector with Vestas CEO Henrik Andersen. That conversation is coming up at 8:15 London time.
Welcome back. European leaders will hold a call with President Trump this afternoon ahead of the meeting with the Russian counterpart, Vladimir Putin, on Friday. Concerns have been growing amongst Ukraine's European allies that peace terms could be enforced upon Kyiv, with leaders warning against concessions to Russia and reiterating calls for Ukraine to be involved in any negotiations. Ahead of Friday's summit, Russian soldiers have pushed deeper into eastern Ukraine, advancing by at least 10 kilometers in the Donbass region in recent days. Ukrainian President Volodymyr Zelenskyy said any proposal to cede Donbass in exchange for a ceasefire would be rejected, warning Russia would use the territory as a springboard for a future offensive. Addressing recent Russian advances in the east, Zelenskyy said steps have been taken.
Today we received reports from our military. The front line, especially Dobropilya and the Pokrovsk direction. Steps have been taken there to remedy the situation. And I am grateful to every unit, every one of our soldiers who are now destroying the occupiers. Positions in the Kharkiv region, positions in the Zaporizhia region, positions in the Sumy region. Everywhere we are trying to provide Ukraine with exactly the protection it needs.
The White House, for its part, again appeared to temper expectations for Friday's summit, with the Press Secretary Caroline Leavitt calling the meeting a listening exercise for the president. Leavitt confirmed Trump and Putin will meet one-on-one as part of the summit, which a White House official told NBC will take place at a U.S. military base in Anchorage. Leavitt also said the meeting should bring a better understanding of how to end the war.
This is a listening exercise for the president. Look, only one party that's involved in this war is going to be present. And so this is for the president to go and to get, again, a more firm and better understanding of how we can hopefully bring this war to an end.
This year has seen a rapid run-up of Europe's defense names, with German defense contractor Rank the second best performer of any stock on Europe's benchmark Stock 600 so far this year. President Trump's election intensified the pressure on European countries to increase defense spending as concerns grew around the transatlantic alliance, with NATO members ultimately agreeing to target an allocation of 5% of GDP on defense and defense-related spending. But that rapid rally has raised questions now about valuations and what impact any potential deal between President Trump and Russia's President Putin could have. We've been speaking to analysts about their outlook for the sector.
We just haven't yet seen the orders come through, right? Some of the stocks are up 2 to 3 times in 6 months on expectations of orders coming through. The orders in Germany, they're really going to start hitting the backlogs of companies. And this is what Rheinmetall said this morning in Q4. So we're in this kind of period where we have very, very high valuations in the short term because we're expecting this significant trajectory of growth through to the end of this decade. But we haven't actually seen the orders to support that yet.
Either the peace process fails, goes off the rails, which, as just said, is always, sadly, more than perfectly possible, if not likely, in which case the need for trying to replenish the depleted arms inventories of US and Europe, that would be very good for orders and procurement for Rheinmetall and all the other European defense stocks. Or if there is a peace agreement, what do we see? We see a very powerful Russian military, which, although the words victory and defeat will be bandied around and should probably not be used, a Russian military which has to an extent prevailed. That reality will force continued increase in defense procurement by European governments and is also good for European defense stocks.
Perhaps the low-hanging fruit from that sector has now been picked. You mentioned a lot of these companies look pretty rich in terms of valuation, but there's a lot of ways to play that market. There's a lot of other companies with contracts in the UK and in Europe that can do well over the longer term. As we see more details about this defence spending, we should see this sector sort of grind higher, I believe. But yes, as you mentioned, I think at the moment, maybe one just to stop and pause.
Renk has posted second quarter sales of 348 million euros. That was ahead of the 338 million analysts had anticipated. The German tank gearbox maker saw order intake grow 47% in the first half of the year. Renk CEO Alexander Segel told CNBC there is still risk to the company's outlook.
On the other side, we also have to say we are facing some kind of headwind. If you look, for example, on the exchange rate, I mean, especially our US business, if you look on the tariff situation by US and Europe, which is from our understanding not fully finalized and settled. And last but not least, we also see from the industry segment, which is playing with 26% of our total revenue share, still an important role. We also see GDP-driven headwinds from these kind of sectors. And we also have to admit, I mean, I think you heard it, we got last week a kind of export stop from Germany for defense goods to Israel. Of course, this is also somehow impacting us in case this would continue for the next months for the second half of 2025. But overall, we are very, very confident with our guidance. We do feel very solid and very strong to achieve this guidance. And as I said in the beginning, we are always trying to strive to be at the upper end of the guidance.